On the campaign trail last year, Elon Musk said he planned to slash $2 trillion from the US federal budget, nearly a third of what it spends in a year. That's a huge number, about the size of the entire Canadian economy. It's also more than the federal government's annual deficit, which came in at $1.9 trillion in 2024 and is projected to grow to around $2.5 trillion by 2035, as you can see here. But Musk has already started taking an axe, or a chainsaw, to federal spending through the Department of Government Efficiency, or DOGE, and also to his savings goal, which he has drawn back from $2 trillion to a more modest $150 billion. So, what impact will Musk's spending cuts have on the US economy and the stock market? We're going to take a look into that in today's video and see what investment opportunities might lie ahead. There's a reason that Musk wants to cut spending. The US government has been spending more than it takes in, running a deficit, since 2001. That was the last time they had a surplus, 24 years ago. And these growing deficits are piling on debt, big time. You can see in this chart that the national debt now stands at over $36 trillion, which is about 130% of US GDP. And as we've explored in other videos, high national debt cuts growth and fuels inflation. Not to mention the sheer amount of interest the government pays its creditors, over $880 billion in fiscal year 2024, which is 13% of the entire annual budget. That's where Elon Musk and DOGE come in. But deep cuts in spending are no easy task. This breakdown of the federal budget for fiscal year 2024 shows why. Nearly 2/3 of the federal government is considered mandatory spending. The funds for these are mandated to be spent by law and can't be slashed without congressional approval. So that leaves the spending that can be changed, known as discretionary spending, accounting for just over a quarter of federal spending in fiscal year 2024, or $1.8 trillion. This money is appropriated each year by the president and Congress. A big chunk goes to defense, $855 billion in 2024, while the rest goes mostly to funding various government agencies, like transportation, education, housing, and so on. This is where Elon Musk and DOGE have been concentrating their efforts since Inauguration Day, canceling contracts, shuttering agencies, and laying off workforces that they deem wasteful or excessive. Now, the question on a lot of people's minds is what impact these spending cuts could have on the economy and the stock market. Here's the bullish case, which really comes down to the numerous benefits of reducing government debt and balancing the annual budget. Just look at this chart showing median GDP growth across 20 developed economies, grouped by debt to GDP ratio. You can see that there's a clear negative correlation between debt as a percentage of GDP and growth rate. In the US, debt currently sits at 130% of GDP, so it's in this group, at the far right of the chart. There are also many other negative side effects of high national debt, like higher taxes to raise revenue, which slows growth. And that's an important one to highlight, since Donald Trump has promised to reduce corporate and individual taxes or even eliminate them altogether, which will only be possible if his government can drastically reduce spending, lest they incur even bigger deficits in the future. So, for President Trump to deliver on one of his core mandates, reducing taxes, he will have to deliver on reduced spending. So if DOGE succeeds in slashing spending and Trump follows through on his pro-growth policies like lower taxes, that would likely be a boon for the entire stock market. And the Russell 2000, seen here as iShares Russell 2000 ETF, might be especially impacted because it tracks small cap stocks which are especially tax sensitive. Many of these smaller companies don't have the resources to move operations offshore to avoid domestic taxes, so they're in a position to benefit from lower taxes that could arise from lower government spending. Another ETF to watch is the Invesco QQQ, which tracks the NASDAQ, with a high exposure to big tech companies. That's because big tech is another sector that could benefit from lower taxes and the other positive side effects of smaller debt and deficits. It makes sense since these companies spend a lot on research and development, so less spent on taxes means more spent on value-defining innovation. But there are some downsides to consider with government budget cuts. Here's the bearish case. One of them is slower GDP growth. Sounds counterintuitive since high debt also slows growth, but government spending itself is part of how GDP is calculated. In 2024, government spending accounted for 17% of US GDP. That's important not just because the GDP number might go down, but because the potential real-world impacts of reduced spending. That's why it matters exactly where cuts are made, which is hard to predict at this point. But a lot of federal money goes to fund infrastructure projects, healthcare, or research and development projects, which have direct effects on productivity, job creation, and so on. So if investment in these areas is reduced, it's reasonable to expect that productivity growth may slow as a result, and with it, economic output. The Pentagon to look into cutting $50 billion per year in spending, which is 8% of its budget annually. That would probably mean a good number of canceled contracts with US defense contractors. This, combined with missed earnings for Lockheed, General Dynamics, and Boeing, and peace talks between Ukraine and Russia, fueled a quick drop of nearly 13% in the XAR Aerospace and Defense ETF, even before the market wide tariff panic. And this decline is coming off a long period of steady growth since mid 2022. So there is a case to be made for both positive and negative outcomes from these spending cuts. If these cuts are gradual, targeted, and paired with pro growth policies like tax incentives and deregulation, they could be bullish for the economy and the stock market. But if they are abrupt, excessive, or occur when the economy is vulnerable to shock, they risk causing economic contraction and potentially accelerating a downturn or even a recession. At Capital.com, we post videos like this regularly to keep you up to date on the latest market trends and economic news. Click subscribe to stay tuned. Thanks for watching.